Macroeconomic theory often assumes there is a sweet spot for state spending, a specific size where the government maximizes growth. But real-world data tells a different story. Across a century of evidence, government spending behaves less like an engine and more like an indiscriminate brake. This idea of an optimal state size was popularized in the 1980s by economist Richard Armey. His Armey curve claimed that economic growth and government size share an inverted U relationship, with prosperity peaking when the state spends between 15 and 25% of GDP. The theoretical curve on this coordinate plane follows a specific logic. In the initial rising phase, the state provides core goods like courts and roads that make private business more productive. But after the 20% peak, the curve enters a declining phase, where high taxes and bureaucratic inefficiency begin to choke the economy. To see if this peak actually exists, we can look at World Bank data for 113 countries. We filtered this set to remove resource-dependent nations and conflict zones, isolating the pure relationship between fiscal policy and economic performance. When we overlay the real-world data, the inverted U model falls apart. There is no rising phase. The countries with the smallest governments consistently achieve the highest growth, while high-spending nations cluster together in a low-growth zone. The Armey curve is a mathematical artifact. The data shows that aggregate government spending acts as a monotonic drag on growth from the very first dollar. The quadratic math used to draw the Armey curve eventually drives the line deep into negative territory. If this model were true, high-spending European welfare states should be experiencing Great Depression-level contractions year after year. But nations like France and Sweden don't collapse. They stagnate. They maintain low, positive growth rates between 0.5 and 1.5%, outcomes that the traditional Armey model cannot predict. If we replace that quadratic line with a power law curve, the math finally aligns with reality. It falls steeply at low spending levels, but then flattens out, showing a stagnant crawl rather than a crash. The regression statistics confirm this fit. The power law achieves an R-squared of 0.422. In macroeconomics, a single variable explaining 42% of the variation in global growth is a dominant signal. This shape reflects the reality of crowding out. The first dollars of government spending displace the most productive private investments. As the state grows, it displaces progressively less efficient private alternatives, leading to diminishing marginal harm. If the regression math holds, we have to stop looking for an optimal state size. At an aggregate level, the state is structurally a brake. This conclusion faces a significant hurdle, the Nordic paradox. If heavy spending kills growth, why are high-spending nations like Sweden and Denmark so wealthy? The answer is the difference between wealth, which is a stock of assets, and growth, which is the flow of new activity. Sweden built its massive wealth with a lean government in the early 20th century. It only expanded its welfare state in the 1970s, well after its industrial foundation was set. Since then, its growth has slowed to match the stagnant tail of the curve. We also must determine cause and effect. Do rich countries just buy more government, or does government size dictate the growth rate? Time-lagged experiments, where countries cut spending during a crisis, provide the clearest answer. In 1987, Ireland slashed government spending from 53%. This choice preceded the massive growth surge of the Celtic Tiger. Singapore has maintained a lean 17% budget for decades, fueling one of the highest sustained growth rates in history. After 1991, Estonia locked in a low-spending, flat tax framework that transformed it into the Baltic Tiger. And New Zealand's structural cuts in the 1980s triggered a decade of modernization and recovery. Because these spending cuts reliably happened before the booms, the primary causal arrow points from smaller government to higher growth. If cutting spending is so effective, why don't high-spending nations like France simply cut their way to prosperity? The answer is in the calculus of the curve. The growth gain from a 5% cut depends on where you start. On the steep head at 20% spending, a cut yields a massive jump in growth. But on the flat tail at 50%, that exact same cut produces a microscopic, invisible gain. This creates a political trap. The costs of cutting, lost jobs, and reduced transfers are immediate and concentrated. But for a large welfare state, the growth benefits are diffuse and take decades to compound. This leads to a ratchet effect. Every percentage point of spending builds a constituency that will fight to keep it. The state drifts rightward along the curve until a fiscal crisis finally forces a change. The calculus of the power law describes both economic drag and the institutional gravity keeping welfare states in low-growth equilibrium. If aggregate government spending behaves like a brake, we have to decide what specific parts of the economy deserve to be slowed. Brakes are useful when applied to destructive activities that the market ignores, such as carbon emissions, overfishing, or systemic risk in the banking sector. The problem is that the modern fiscal state applies this braking force indiscriminately. Massive programs for transfers and public employment slow down the entire economy, including the productive investments we need for long-term growth. To fix this, we need to minimize the indiscriminate braking of aggregate spending, and instead target the state's power using an objective mathematical rule. The objective rule is the inclusive wealth criterion, a matrix asking two questions. Did affected parties consent? And did wealth grow or shrink? In 3 quadrants, the state does nothing. It only acts in the bottom right quadrant, where wealth shrinks without consent. To measure if wealth is actually shrinking, we use a shadow price formula. Think of a shadow price as the true value of an asset, like clean air or a legal system, that doesn't have a price tag in a store. We tally the net change across every form of capital: produced infrastructure, human skills, natural ecosystems, knowledge R&D, and institutional rule of law. This creates a 3-step sequence for intervention. First, there must be a failure of consent. Second, the net result must be a shrinkage of our shared capital base. And third, the cost of the government's brake must not be worse than the damage it's trying to stop. Compare 2 cases. A coal subsidy destroys natural capital and human health for populations who never agreed to it. It fails the test, and the brake should be applied. But a grant for basic science creates knowledge capital with benefits for everyone. It passes the test, and the state should leave it alone. The empirical data suggests the Armey curve has failed. Building a wealthy society requires releasing the economy's natural growth by slashing aggregate spending, while using the state's power only to tax the depletion of our shared capital.